Welcome to Mark Arnold's Finance. This week has been a roller coaster ride for us investors. We had the Fed on Wednesday come out with a hawkish view, which sent the stock market tumbling down. And on Friday now, we have some positive job numbers, and China is signaling that they might ease COVID restrictions, which would benefit our portfolios. So when we have these roller coaster volatile times, there's one company that I want to talk about today that I think will do very well during any recession, during any volatile times, and that is Cisco Systems. Their ticker symbol is CSCO. Now, I do hold this company in my portfolio, and I want to show you guys my portfolio performance here in just a second. If you appreciate that type of transparency where someone just doesn't talk about what they hold but actually shows it, this is the channel for you, and I'd appreciate it if you give it a shot and subscribe. I share the good and the bad and everything in between. So let's look at my portfolio performance, and we will see here that my portfolio is now down 9.76%. So it's a little bit more in the red than last time, and that is an unrealized loss of $4,600. If we focus on the technology sector, we will see some companies that are heavily in the red, but one that is hanging on strong in the green, and that so happens to be Cisco Systems. It is in the green for me by 4.7%. And it's a 2.69% allocation of my portfolio by market value, so it's a smaller holding, but one I want to bump up because of some things I'm going to go over in this video, which let's get started on Cisco. This company is in the technology sector, and it's in the communications equipment industry. It has a strong brand because it's been around for a long time and it dominates the industry, and it has networking switching cost, which means a company that does business with Cisco is less likely to switch over because of some high costs to do so. So between that strong brand and that network switching cost, it creates a small moat for this company, and a moat is great. If you're an investor, you want a company that has some type of moat, whether small or big. Of course, the bigger the better. It also is shifting to subscription-based services, which will add stability and, in my opinion, growth, because that's reoccurring dependable revenue. Now, Cisco Systems designs and sells a broad range of technologies that have been powering the internet since 1984, so before I was born. Across networking, security, collaboration, applications, and the cloud, Cisco is integrating intent-based technologies to help customers manage more users, devices, and things connecting to their networks. And of course, with the work from home increase, this company became more important. Products and technologies are grouped into infrastructure platforms, applications, security, and other products. Increasingly, the company is delivering technologies through software and services, which is that subscription-based model. Cisco Systems is the world's largest hardware and software supplier within the networking solutions sector. So that is so important to know. Now, this company does have a strong balance sheet, and we will see here that its liabilities to assets is at a 57.7%. This is healthy. Anything below 60% is great. Anything above 75% is where I start to get a little worried. Now, they do have high earnings quality, so between their strong balance sheet and their high earnings quality, this company I feel is a low risk for an investment, which is great. Now, speaking of risk, let's talk about their dividend safety. Now, their dividend has been paid continuously since 2011 and increased for 12 consecutive years. So that is very good. Its dividend yield right now is sitting at a 3.47%, which is great. My high yield savings account now is at a 2.5%. So you're getting an extra percent with this company, and I feel it's a low risk company. Now, their payout ratio is just a little high for my liking. I like anything below 50%. This company has a payout ratio of 54%, but still not anything in a red flag area. So when we look more into this company, we're going to see some other strengths. So this company has a low probability of their dividend being cut. So it's very strong. Now I want to go over some strengths, some weaknesses, some opportunities, and threats. Now, this company does have good management and financial strength to transform from individual products to a solutions and services company with more subscription revenue. So for a long time, this company just sold individual products, but it's seen how the subscription-based model has been so beneficial and profitable for so many companies in the technology sector, which is causing it to move more towards that, which I think is fantastic. They have a large established clientele, which is an advantage to provide new services, right? If you have an established clientele, they're more likely to adopt your new products and services as you roll them out. This company is open to change, and Cisco is one of the top 20 research and development companies in the world. And that is so important, especially in the technology sector. So those are its strengths. So some weaknesses are this sector is a mode of continual and aggressive change requiring reinvestment and innovation. But I think they answer that by being one of the top 20 companies that do research and development in the world. And so I think that kind of cancels it out. So the weakness that I found was kind of answered by their strength. Now, opportunities with their strong balance sheet, they can acquire small companies that they deem are their competitors. And they have a history of acquiring small companies. So I don't think they'll slow down in that area, and that they can focus more on the innovation and the move to subscription-based model. So that's their opportunity, which they're already moving to the subscription-based model. I feel they're already being innovative with their high investment in their research and development, but they need to continue to focus on acquiring the competition, because all it takes is one company to really break out and cause you some pain. The threats with this company are that cloud-based solutions are causing the sales of Cisco's older products to decline. Their gross margins on these products will likely decline as well. And that's just how it works. If things are going to be put in the cloud, companies won't be so heavily reliable on their individual products. Also, a threat is the technology sector changes quickly and competition is fierce, which I do think that this company is focused on being innovative because they put so much money into that research and development. So now I want to look at the metrics that my metrics chart that I put together for this company, which I put forth what I deem as the most important financial measurements to look at. So let's look at that now. We will see here that with Cisco, anything in green means they're far above the industry average. Anything in red means they're far below the industry average. So with their PE ratio trailing 12 months, they're at a very attractive 15.55 PE ratio, which compared to the industry is very low. Now their 5-year average is 134.5, which is in line with the industry. So that's very interesting how far this PE ratio has gone down. Their earnings per share, 12 months versus prior 12 months, is 12.8%. So about average for the industry, but its earnings per share growth over the last 5 years is low at an 8.22. So something that I think this company will improve over time due to some other measurements we'll see. Revenue, both trailing 12 months and 5 years, is average. I'd like to see this grow and become higher. Their cash flow growth is lower than the industry at a 3.44, but I will say I think a lot of their cash is going to acquiring companies and that research and development. So I don't see this as a red flag because I think they're spending heavily in that area, which will benefit them and hopefully create some good returns in the future. We went over their dividend, but we'll touch lightly on it now. They have the yield of 3.47% and the payout ratio of 54%. And their 1-year dividend growth is very small at a 2.7%. And I think it's because of that high payout ratio. So that's how that can affect a company's dividend growth. So I think they'll continue to grow it because they want to hold on to that 12-year streak that they have. But it'll just probably be low percentages like this, which is, in my eyes, not that attractive. Now, where this company shines is the next 3 measurements, and that's the total debt to assets. This company is low leveraged at 11.76%. And when you go into times of a recession or hard economic times, those companies that have low debt, that are low leverage, are going to survive and thrive compared to the companies that have high debt. Those companies are at risk of going out of business. So this I really like to see, and that's why I say during these roller coaster times, this company will do well. Also, their gross margin is at a 65.75%. That is very attractive. Now, gross margin is the amount earned in profit per dollar of sales. So this company is doing very well, and that will also help it get through some recession and volatile times. Of course, their margins might shrink some, but they have some room there to shrink, and they'll still be attractive in my opinion. And once they do get more into that subscription-based model, I think these margins will go right back up if they do shrink. Now, return on equity is also great. In the trailing 12 months, it was 29.1%. And with return on equity, this is a corporation's profitability and how efficiently it generates profits based on different investments. So, if you want to invest in something, what's your return on it, right? well, this company is doing well compared to the industry average, and that's great. They are reducing their shares outstanding, which is awesome. That means they're not diluting us. They're creating us to have more of ownership of their company per share. And their market cap is at $180 billion. So with Cisco, what I will say is I think those metrics were excellent. I think that's great. That's some solid metrics that I think creates a low risk investment. And so right now this company's at $44.50 in the stock market. And I do rate this company a buy. And I think it's a buy at $45 or below. And that's comparing all the metrics that I looked at in their history. I just think that's where this, and the future growth too, I think that's where this company is attractive and where you're giving yourself a level of safety. So I'm going to keep buying Cisco because I think of its strong balance sheet. That's going to provide it those opportunities to move more to that subscription-based model. It has the very established clientele, and I think it'll increase its profitability in the future. So this company reports its earnings on November 16th. So if you're an investor, be sure to note that, or if you want to invest in this company, note that, because that's going to help us see, with all these other tech companies mostly doing bad, I want to see how Cisco's system does. That'll really be determine whether I'm correct in that this company will hold strong during volatile recessionary times. So yes, let me know what you think of Cisco. This is a solid company, I feel, with low risk that will provide me some good returns in the future. I like where they're pivoting to with the subscription-based model. And yeah, I think this company has some great strengths. With its weaknesses and threats, I think this company can overcome those pretty easily and take advantage of its opportunities. So let me know if you invest in Cisco or are planning on investing in Cisco and where you think this company is a buy. I say 45 and below. I'd be curious to see what your thoughts are on where you'd buy Cisco, if you think it's a hold or a sell, and what your strengths and weaknesses for this company are. Let's share that so we can start a conversation and all learn more about this company. But I am a happy investor. It's obviously holding up very well for me. Of course, it'll report its earnings, so we'll just have to see. But with that said, I hope you guys have a great day. Be sure to subscribe, and we'll see you very soon on Mark Arnold's Finance. Thank you so much.